Um, the name used by investment firms that offer this is convertible debentures, or PIPE, which means private investment in public equity. The targets are, they would say clients, I would say targets, are generally small companies who need capital, but aren't at the stage where they can get cash from stock sales or bank loans or bonds. In one case, the investment firm says, we will lend you $2.5 million. That's the sum that was promised the company that was caught in this trap. It would be paid back in stock equivalent from $2.5 million. The loan was $2.5 million. They would pay back stock equivalent to $3 million. But at various dates, the investors would request conversions of the debentures until the $3 million was paid back. The company hopes this money will help them grow and the stock price will go up. And this makes this a very good deal. They don't know that some of the investment company people and the people they're working with are corrupt. Now you have to know about naked short selling. Naked short selling is where an investor sells a share he doesn't own. Yes, this is allowed by the SEC and other countries, and must borrow or locate it in the stock of some other company that has that stock. Borrow means his broker borrows it from another broker who takes it from a margin account of a client who permits the stock to be loaned because they're not paying for the whole amount of stock in cash. And the broker gets interest on the loan and sends the borrowed shares to the buyer, to the seller who sends them to the buyer. In 2 days, the short seller must pay back the loan. A locate means the broker knows where the stock can be obtained. This is usually fake, doesn't really know anything. And the seller must send the shares to the buyer in 2 days. But the naked short sellers never cover. They never send the shares to the buyers to begin with or after the 2 days. And they increase the number of shares in the marketplace because the buyer who never got delivery in the DTCC, which is the clearinghouse for shares, that person has gotten a digital entitlement. Well, the real owner of the shares still has a digital entitlement. So you increase the number of shares in the market, and that drives down the price. And when they are involved in death spiral financing, that's what happens. So, but it's deliberate to the point of real conspiracy. The naked short sellers knock down the share price. So by the time the conversions are required, each tranche will be paid back in many times more stock. So that if 3 million would have given, just take a number, the lenders a tenth of the company, by the time they're through, they'll own most of the company, or maybe even push it to bankruptcy, which means they never have to cover the shorts, the naked shorts, because there are no more shares. So let me tell you about a particular case. Eagle Tech, based in Fort Lauderdale, Florida, was started by Rod Young, who had developed the use of a single telephone line for one number, Follow Me telephone service. Now, it's not so surprising. At that time, 20 years ago, it didn't exist. He needed money to develop the invention, and he fell into a death spiral trap. He thought the deal was honest because it was sponsored by Salomon Smith Barney, then owned by Citigroup. Meetings were held at their offices. Notices were sent out on Salomon Smith Barney letterhead and in Salomon Smith Barney envelopes. The Salomon leader of the deal, John Dorosky, worked with a bunch of mafiosi, literally mobsters, who fronted for investors that were really offshore shells. The agreement that Eagle Tech signed with Salomon banned naked short selling. But the chief mobster involved in the deal, John Cerubo, paid illegal commissions to some cooperating brokers to do just that, naked short sell, not cover. So, and then the investments didn't materialize, or they were canceled out by the massive naked short selling. But other so-called proper companies were involved. Knight Securities, a broker-dealer, facilitated a series of coordinated, synchronized short sales to drive down the price. In one case, a high of $13.25 to $7.75, and giving the shorts a profit of $5.50. So at a certain point, this kept happening. EagleTech finally smelled a rat and refused any more conversions that would transfer the company to the Solomon Smith Barney co-conspirators. Now, the FBI was investigating some organized crime stock fraud. It busted 17 mob members in New Jersey, led by the crooks that ran the scheme against EagleTech in cooperation with Solomon Smith Barney. It never got near Solomon Smith Barney. In February 2005, the SEC brought a securities fraud case against Cerubo, a leader of the mob, and more than a dozen others. It said they generated over $12.7 million from the sale of stock. And Cerubo and the other mobsters would be banned from penny stock trading in order to pay back the ill-gotten gains. Now, Solomon Smith Barney was a member of the New York Stock Exchange, which is subject to oversight by the SEC. And the SEC and the Justice Department never got involved in looking into the role of Solomon. EagleTech's lawyers, and Wes Christian, the main lawyer, told me, we contacted the SEC on that and got no response at all. He said it was gross negligence. I think it's more than negligence. I think it's corruption. So the court dismissed the EagleTech suit because it said it lumped 29 defendants together and failed to identify which defendant made which statement, which I think on the face of it, when there's a conspiracy, it's pretty outrageous. Then the SEC, this is the final, the coup de grace. The SEC filed suit against the victim, EagleTech, to deregister its shares because it couldn't afford several $100,000 to file audited financial reports. So delisting is like a bankruptcy. All the investors are wiped out. The naked shorters never have to cover. So the SEC figured what the mob started. It killed the company. There's a very similar story happened about the same time. Sedona was a software firm based in King of Prussia, Pennsylvania. It was making relationship management software for companies. Again, this was 2 decades ago. There wasn't a lot of it around. It had some deals working with IBM and other top line financial companies. It wanted to hire more staff for sales and marketing. So in this case, the investment banker was Ladenburg Thalmann, which was considered a very high-level investment company. It was prominent. It was a member of the New York Stock Exchange since 1879. Its major investor was Carl Icahn. From this company was a man named Michael Vasinkovich. He was soliciting Sedona's business, promising he could help finance the company growth. He could get Sedona, that's the $2.5 million, in a pipe deal, private investment in public equity. He was working with 2 Austrian brothers, the Badians, and they were introduced as investment advisors. They work through a network of offshore funds, advisors, directors who seek out target companies. The investors, the shell companies in this case, were controlled by Herbert Batliner, who, according to a 1999 German intelligence document, which I obtained, was in the business of laundering illicit funds. And the U.S. prosecutors told a Colorado federal court in 1999, and this is public, Batliner had handled money for drug dealer Jorge Hugo Reyes Torres, then was serving a prison sentence in Ecuador. So this fine group, the Badians, through their Rhino investors, their shell company, pumped $2.5 million into Sedona in 2000. And they made a convertible debt offering, which would be converted at various points. And the deal was written. The investors would not short sell the stock. But of course, that would be a lie because short selling would push down the share price and they would get more shares for the $3 million. So it came time to convert the shares. When the deal was signed in 2000, the stock was trading at $6 a share. They in a month they pumped it up to 10.25 from 6. Then a long slide. Every time the company put out good news, such as a relationship with IBM, should have made the stock go up a lot. There was a heavy sell through electronic communications networks that allow the seller to hide behind the ECN. And in a month, the Confederates pushed down the stock to $1, $1.01. Now, when Andreas Badian learned the price of the stock had fallen below $1, he told the brokers at Westminster, fine New York brokerage, according to tapes, which now became part of one of the legal cases, to, quote, keep selling and use unbridled levels of aggression because every dollar that you sell is a dollar in my pocket. And meanwhile, the phony clients were converting the shares to cash. And so they ended up, Sedona still owed $1.9 million after all the conversions. And they were deposited, the shares were deposited into another fine firm, Westminster Securities in New York. And Pershing, a clearing firm for Westminster, shared office space with some of the Badian funds. I'm trying to point out that, like in the Eagle Tech case, you have some very grungy crooks and you have some very fine Wall Street firms. Badian directed Westminster to engage in manipulative short selling, and Pershing brokered the transaction. Another company, a market maker named Frankel, made fake book entries that said it had bought the shares through a broker in Canada. And so Sedona one day received an investigator's 330-page ring binder. There's an investigator, I think I know who it was, had been looking into this whole special part of the naked short selling scams, the death spiral financing. He had analyzed 60 companies destroyed by the Badians and similar operators. And then in 2001, Badian demanded another conversion. Sedona decided it was dealing with crooks, and it refused. It got an appointment with the SEC and the Justice Department, had meetings. The SEC found out that 82 companies reporting investments by the same scammers, of them, 81 lost almost 40% of market value in the first year. And Sedona lost a lot of business because if your stock is tanking, companies don't want to buy software that you are not going to be around to service. So Sedona had to fire employees in sales and marketing. So following meetings between Sedona and the Justice Department and the SEC in 2003 filed a complaint against Badian and his company for fraud and market manipulation. You know what the settlement was? It was $1 million. That was chump change. That was the cost of doing business. And they did not have to admit or deny guilt. They were big-time crooks. They got off. The Justice Department charged Badian in a criminal case. He jumped bail and is a fugitive in Vienna. And then finally, the Justice Department just dropped its criminal case against Andreas, and it would not say why. So in May of 2003, that's when Wes Christian got involved. He filed a civil suit for Sedona against Laudenberg, which was the big guy, and Vasinkovich, Badian, and some others. Finally, the SEC filed a suit against Badian, but not against Laudenberg, and or against Westminster or any of the other major brokers involved. And Wes Christian told me the U.S. government chose to go after the low-hanging fruit, the Badians. They had the clearing firm, the broker-dealers, they had it all, but they dropped it. The judge in New York sat on the cases for nearly a decade. She dismissed most of the Sedona defendants, including Badian and Vasinkovich, and the alleged co-conspirators, Pershing, Westminster, Frankel, got a pass from the SEC and the Justice Department. Finally, Wes Christian settled with Laudenberg Thalmann. He can't indicate the money of the settlement, but obviously Laudenberg at a certain point decided it might not be good publicity for them. So Sedona is still in business. It now has a market cap of 1.9 million. The stock is trading at 2 cents. This is what death spiral financing does.